I'm Joon Hyuk Heo, lead portfolio manager of Mirae Global Fixed Income Bond Funds. I'm based in New York and have been in charge of Mirae Global Fixed Income strategies since 2008 from Hong Kong. Mirae Global Fixed Income teams are composed with 34 investment professionals from 5 countries, including Korea, US, Taiwan, Hong Kong, and India. And we have 23 investment professionals dedicated in global fixed income markets. Mirae's global fixed income strategies are composed with about $4 billion equivalent amount of global total return strategies, $400 million equivalent of US CMO strategies, and emerging local currency, global high yield funds, US investment grade corporate fund, and emerging corporate dollar fund, and some specific country funds. In total, the total AUM we are managing currently is roughly $5.5 billion US dollar equivalent. I'd like to introduce our flagship global fund strategies. I've been involved in this fund since the inception in 2006. And these strategies are seeking total returns and try to capture global opportunities through the unconstrained investment approaches. And this fund is kind of benchmark agnostic strategies, and it's a very flexible strategy and want to achieve various type of investment opportunity from various type of asset classes and countries. The investment goal of this fund is seeking very stable return without any significant downside risk. In order to achieve such kind of the risk return profile, we are dynamically allocate between emerging markets and developed countries fixed income market, between defensive sectors and very stable sectors. And by doing that, we can achieve a stable return without any significant downside risk. Let me introduce our investment process. Our investment process starts with top-down macro analysis and risk budgeting and sector allocation, security selections, and the portfolio review and risk monitoring. At top-down macro analysis, we check various type of economic indicators, political event, monetary policy, and some unexpected event also, to measure whether there is any significant risk in global financial systems. We believe if there is not any significant risk in global financial system, by investing in risky asset with a diversified approach, we can achieve a higher return without a significant downside risk compared to very stable asset classes. So this stage is very, very important, and most of our research focus are on this global macro analysis. After we evaluate global macro situations, we try to decide how much risk we want to take. So we can call this stage as risk budgeting. And at the risk budgeting stage, we try to decide risk from duration, risk from macro countries, risk from credit, and risk from other type of risks which can give us additional return compared to safe asset. At the sector allocation stages, we'd like to decide how much asset to be allocated between risky asset and safe asset. In safe asset, we regard US treasuries or other developed countries' government account debt as safe asset or cash. And among the risky asset, we recognize emerging countries' sovereign debt, dollar debt, corporate debt, local currency debt, and the US investment grade corporate or high yield as risky asset. Based on our risk budget, we like to achieve that risk budget goal by allocating asset among those safe and risk fixed income sectors. After we allocate between and among the fixed income sectors, each portfolio manager who are dedicated to specific market achieve to return higher than given benchmark to their specific countries or specific index. We do not use any index when we evaluate performance of the fund itself, but when we evaluate performance of security selections, we use specific market indexes. After the security selection process is done, we evaluate asset allocation performance, security selection performance, which were decided in our investment process. And we try to figure out whether our decision at top-down analysis, at risk budgeting, at sector allocations, and security selections, and try to modify our positions based on our view in global fixed income market. Even though we are investing in global fixed income market, we do not follow any well-known benchmark index. Let me explain why we are taking such kind of benchmark agnostic approaches. From 2008 to 2015, various types of global fixed income markets performed very different type of returns, and there is no any single sectors which performed continuously better performed than any other sectors, and volatility of each individual sectors were very wide. So if we follow any index, long-term return would be similar to that market's long-term performance, but volatility the investor has to experience would be very big, and the fixed income market is quite unique, because if there is any drought, the next year's performance would be quite good, but investors' risk tolerance is usually lower than volatile assets investors. So we believe by diversifying among risky assets, we could achieve smaller volatility, and which can give investors opportunity to be exposed to risky asset ongoing basis.